Welcome, everybody. Welcome to the Keystone Financial Studios. Jeremy Busch and myself, we are certified financial planners and financial advisors, financial planners. We get called different things, right, from time to time, but that's our occupation, right, is trying to understand the markets, understand the financial world, and give you an alternative, if nothing else, right, to just trying to learn from the media. Obviously, the media serves its purpose, but these days it is a lot of clickbait. They're definitely going to be reporting more on the negative, and oftentimes advice that you might be getting there may not be in your best interest. It may be something that would get somebody to click, right? Get somebody scared or upset or something like that. But oftentimes, find that's not very helpful as far as making financial decisions. So today we're going to be really talking about mid-year 2024. So obviously that means that we had a forecast presentation back in January. And it's been a pretty good year, by and large. Certainly, there's a lot of curveballs. We can listen to all the experts. It doesn't matter who they are, whether it's the president, the Federal Reserve, the European Central Bank. You could listen to the people that supposedly know everything, but they don't know everything. They can't predict the future, so they're all guessing too. Even if it's good educated guesses,
Absolutely.
they're all guessing too. So as we pay attention to what the experts are saying, keep that in mind for the second half of the year, is that there's likely to be a lot of other curveballs that end up coming up. So one thing that you'll note too, if you didn't hear in the intro, one thing that you'll note is that the slides we presented were actually sent off to our compliance people. We have a very regulated industry, and so all of the numbers are as of June 30th. And we actually thought about, saying, hey, we're not going to use the slides, but it's actually, as we go through it, there's still a lot of things that are relevant, and we'll correct as needed, right, for things that have been updated. But there are a lot of things that just haven't changed a whole lot, despite a lot going on in politics, especially in the news, with geopolitical stuff and war and so forth. That's probably not going to stop. We're going to continue to see a lot of uncertainty going forward, but fundamentally, there are a lot of things that haven't changed despite all of that. So we're going to talk about a couple of things first. This was written by some great attorneys, I'm sure, right? So risk considerations, everything we talk about is just our opinions, of course, right? And you should always take that with a grain of salt, no matter who you're paying attention to, right? Is that they don't know either, right? Regardless of how smart they are, how educated they are, who they're paying attention to, they still don't know. So what we're really trying to do is distill a lot of what the experts are saying in the environment that we're in, and using our experience and really trying to give you some insights, so you feel more comfortable, right, going forward in the environment that we're in. So a couple of disclaimer slides here at the beginning, and we are off to the races. So key forecast, just to kind of give you the bottom line of what we're going to talk about. And again, this hasn't changed. None of these things have changed since June 30th. So despite this being presented in August, a lot of this hasn't changed. First of all, the economic expansion that started in 2020, following the pandemic, of course, right? We had a huge slowdown in the global economy. That is going to continue. We don't see a recession at this point. That's not in the forecast. Hasn't been in the forecast. Of course, recessions do happen. That doesn't mean we won't have one eventually, but we don't think that we're going to see one in the near future. So stay tuned on that. Second thing, the S&P 500. Where are we today, year to date, Jeremy?
Today we are at about 10.6 last we checked.
Yeah.
So yeah, we were looking, originally while we were putting this together, somewhere in the realm of about 17 to 20% at year's end, which could still definitely happen.
Yep, annualized, I think we could still very well end there. Of course, we've seen a pullback here this last week, and there's a few reasons for that. But we saw a pullback, and it's natural. Historically, we have a correction about once per year, right?
Absolutely.
Statistically, and that's kind of what we're experiencing right now. Of course, everything isn't equal, depending on how you're invested, right? Especially if you were undiversified, could have been a lot better or worse than that, right? But overall, the S&P 500 is a pretty good gauge, right? I think a lot of people pay attention to that as their benchmark for the overall market. So yeah, the forecast was 17 or 20% before. We're still sticking to that. We still think that that's likely to happen, that we get to 17 to 20%. We see this as being a correction, and statistically, stats are on our side, right? That most corrections actually don't turn into bear markets. I think 70, 80% of the time, somewhere there, the number holds pretty strong over the last 100 years, that even though there's a correction once per year, being defined as a 10% or more drop in the overall market, 20% would be considered a bear market. And again, there are certain sectors of the market right now, some of the high flying, Mag 7 stocks, things like that. Some of those are actually down more than that. But again, you'd have to be really undiversified to have all your money in that one area. We would never advise that. In other words, that people get so overly concentrated. So we're still sticking to it, 17 to 20% for the year. Still seems realistic based off of what we're seeing in the numbers. But again, that's just a forecast. Just like the weather folks, people predicting wildfires, any of that stuff, right? They don't know either. They're just giving you their best guess.
Absolutely.
Yeah. How about the bond market?
Yeah, and then really what we have seen and what we're seeing in the trend also is that aggregate bond index is actually outperforming short-term treasuries. So really, I think coming into this year and for the first part of the year, short-term treasuries looked really good. They're paying 5+% on a lot of this stuff.
Yep.
What we're seeing is really that aggregate bond index, which is really just a mix of a lot of different varieties of bonds, a lot of different durations, is actually starting to outperform that short-term thing, which kind of points us in the direction of maybe that yield curve starting to normalize a little bit. Right?
Yeah. Versus we were inverted before, right? And inverted means that you're actually being paid more on shorter term securities. Kind of think in terms of maybe what you might own at your bank or your credit union. You might have a short term CD paying higher interest rate than a longer term CD, which logically makes no sense, right? Why would you lock your money up for a longer period of time? That's usually a sign of a possible recession, at least. That doesn't always hold, but a sign of a possible recession. Now we have seen that normalize. And, markets, I know everybody's talking about politics right now. It's kind of hard to avoid that. Any conversation you get into, any, radio or internet, anything you look at, it's just bombarding us, and it will until election day and probably even after election day, right?
It's hard not to take that in, because you're inundated with it all the time. And this candidate's saying that, and that candidate's saying this, and that's nothing more than their opinions as well, just as much as this is ours. Right. So it's our job to kind of look at the numbers, look at the data behind the numbers, and try to provide you with the best, information to move forward with.
Yeah. We've got a couple of slides on that later. They're kind of interesting. It's not to say that politics don't matter. So we don't want to say that. Obviously, there's all kinds of social issues and things, right, that might be important to you. But if we're just thinking about things from an economic standpoint and things that might impact us individually, right, our own tax rates, our own benefits, Social Security, things like that. Obviously, a lot of very important issues that are being debated. But as far as how the market reacts to that, if we take the long view, sometimes the market doesn't care a whole lot. As far as kind of who's in there, as long as there's some certainty, right, of knowing, who's in office. That's one reason why the market kind of likes gridlock, and we're going to talk about that here in a bit. So some more to come. Obviously, in the last month, lots of stuff has been happening with politics. So mid-year outlook, this is a kind of a busy slide, but what it does is it kind of gives you an idea of the different areas of the market and what the experts are saying, right, as far as areas that they're personally suggesting that people overweight or underweight. Our view at Keystone is always to stay very diversified. So we don't like being we don't like being lucky, in other words, because that means that we're relying on things we can't control. Right. So I think it's really important that you recognize that a diversified investor, while doesn't guarantee anything, right, it's a lot safer place to be. And it is trading off, right, the ability to make a killing. If you've been overly concentrated, say in NVIDIA or Apple or Microsoft or certain stocks that have been flying really high before, you're kind of trading that off for getting killed. Right. I mean, if one of those goes way down, and we've seen that in the last week.
We have seen that. So we've actually seen a lot of this play out. So that first bullet point there, expect the U.S. to outperform the rest of the world. It actually has done better, especially a lot of the Asian markets. They've taken some pretty big hits recently, we're less so than they are, obviously. But I like the third point on this one where it's, looking for the broadening participation. So we're not just looking at 7 tech stocks. Right.
That's kind of what we have been seeing.
Absolutely.
Absolutely.
So it's may have started out the year that way, and they pushed a lot of the S&P up that way. But since then, it's been spreading out a lot more.
Yeah.
And
Yeah.
so that's a good thing to see
Yeah.
across the broader market.
Yep, absolutely. Yep, being very diversified. It might be boring. You know, it might be more boring than talking to your coworker about day trading Nvidia stock or Bitcoin or something like that, right? And we know that happens, right? Yeah, that's the real
Everybody
world.
knows somebody.
Yeah, exactly.
Yep.
But there's not very many people who can consistently do that. In fact, Warren Buffett has said that consistently over time, that that he's never met anybody who can consistently time the market, right? So. You know, there's wise decision making that can happen. It's not to say that you just kind of wing it, right? And don't look at anything related to the economy. But overall, some of these overweights, we do expect that the U.S. is still going to hold. A lot of these haven't changed. In other words, our view hasn't changed. Small and mid cap should do better as the economy continues to improve over time. And we still think that we're going to avoid a recession. We hope we're right there. We don't know. And then, yeah, again, broadening that participation, it's not just a handful of stocks. We're starting to see that the overall market is participating more, and that really is more of a healthy thing. Some of you might remember the late 90s where something kind of similar happened, right? That you had a lot of .com stocks, a lot of tech stocks that were just flying really high. And of course, that ended up badly, you know, in the end, they ended up being a big bubble, right? Because a lot of people piled into those same stocks, and we want to avoid making that mistake. Like some people did. So, yeah, outlook, we look at the rest of the market. We do prefer stocks, again, overall as a category. And that being said, that is maybe a bias that we have, as we do like stocks and real estate too, those two asset classes as long-term holdings. And real estate could be your house, right? It could be that's your exposure to the real estate market. But really, those are the two asset classes that, at least given enough time, those two asset classes have done a pretty good job at outpacing inflation.
Absolutely. And really, and I think the other part of that too is, you know, bonds have really kind of carried us over the last, you know, year, 18 months, I think, for a lot of that.
Yeah.
As the Fed does eventually get around to dropping interest rates,
Right.
you know, that'll play into bonds again as well. But
almost certainly next month, you know, at this point, it would be really unlikely that they wouldn't cut. In fact, I read that this morning, 70% chance now. You know, again, these are the odds makers, right? 70% of the odds makers are saying that there'll be a 50 basis point or a 0.5% cut in September. So
which makes sense, because I think the inflation numbers are, you know, continuing on the trend that the Fed has been watching, and their key indicators are moving in the right directions that they want them to move. So it would make sense. Yeah,
absolutely. And then underweighting cash, overall, it's not to, this is different than your emergency fund, right? We're not talking about, you know, that you should go to no emergency fund. Don't keep any money in the bank. We always recommend at least a 3 to 6 month living expenses buffer that you've got in cash just for emergencies, for unexpected expenses. Sometimes more, depending on your situation. You might want more in cash if you know you have major purchases coming up.
Absolutely.
That's just a sound financial planning principle. And then, you know, modest exposure to alternative investments, not right for everybody, but having diversifiers in the portfolio, things that don't perform exactly like traditional stocks and bonds, could be things like commodities, could be gold, other things like that, but in a very modest way, because any of those alternative investments are going to be very risky alone. In other words, you would never want to put your money all into one area. So again, not right for everybody, but certainly want to look at your situation and make sure that we understand it, right? So we understand your appetite for risk and how much return we're trying to get on your portfolio.
Absolutely.
Yeah. Great.
And of course, you know, when we look, so we are still in a bull market, right? And when we look at the average of these, we're still in a young bull market by the looks of it.
Yeah. Yeah. And we hope it continues. Again, we hope that the odds kind of hold on this one, right? That this market doesn't turn into a bear market. So hopefully, if we just look at the averages, hopefully we've got a few years left, right? That the overall trend is up. And trend is, I think, a really important word, right? What we're not saying the market's not going to go down, right? Of course it is. Just like if you get in an airplane, you're going to have turbulence. And it doesn't matter how good the pilot is or how well you try to time it. And gosh, I'm going to try to fly during a time of day that is less turbulent. You're going to experience that. That's just part of being an airline passenger, and same thing with the market. If you're in the market, you're going to be participating in that turbulence as well. That's kind of how you get there over time, right? That's part of the overall experience. And it's people that stay in over the long run that tend to get the best returns, not people that jump in and out.
So like you mentioned too, is that, 10% corrections happens on average once a year.
Yep.
Right.
Yeah,
So
on average, could
on
happen more
average,
often. Yeah.
yeah, it has.
Yeah.
But still, it's nothing out of the ordinary,
Mhm.
what's happening in the market right now.
Yeah.
Especially in, years like this, and like you had mentioned with media kind of playing into this and an election year,
Mhm.
you're
That's
inundated from both sides on this
absolutely.
stuff. And so you have a bunch of people in the market who are trying to navigate what they're hearing and what's
Mhm.
coming out of everywhere. And so it's a lot to digest.
It is. It
So
is.
causes volatility.
Yep. Yep, it sure does. And uncertainty causes volatility overall.
Absolutely.
Yep. And again, we don't expect that's going away. So hold on to your hat. I think there could be more curveballs by the end of the year. So, and again, on average, about 5 years is how long bull markets last. Sometimes they last a lot longer. The one leading into the pandemic, in fact, I remember we gave the forecast presentation right before everything shut down in early 2020. And that was one of the comments, I think we even made, right, was that was the longest bull market ever, right, in history, longest expansion ever that we had seen prior to that. So obviously COVID happened. We did have a bear market. We had a recession, and we've been recovering from that. So yeah, again, statistics are statistics, right? But I think it's interesting just from a perspective standpoint.
Absolutely. So this is kind of an interesting one, specifically because
It's
it
changed.
changes to the
Yeah,
presidency.
yeah,
Right?
exactly. So it's neither one of these scenarios, exactly, right?
Absolutely. So yeah, so really what typically what you see and what history tells us is that election cycles do support that bull market. And so it depends on, what presidency is happening, right? And so fourth year lame duck would suggest, the incumbent basically cruising along. That was the case
It was
until recently, which
Yep.
is no longer the case. Fourth year of a new president, again, not quite there. So I'm thinking probably somewhere in between on this.
Yeah, it probably is, because the reality is now that the President Biden has said that he's not running for reelection. Now Harris is going to be in, right, as the candidate. And so it's a little bit different in that you've kind of got a lame duck now, right? I mean, essentially you've got Biden suddenly has become a lame duck president. Yet you've got the new president, more or less, if Harris becomes the president, more or less they're forecasting right now that the policies that she would follow would be very similar to what President Biden has followed. Whether you like that or not, either way, right? We're not commenting on if that's good or bad, but the reality is she was and is his vice president, and that the policy making likely will be the same. A lot of the same, even cabinet members, things like that, that will likely continue on in the future. So it'll be interesting to see what happens. Certainly, again, lots of curveballs could happen, but yeah, and I don't think maybe once in history, I think as a president, had a gap, right, where they lost an election and then came back to win another election. Is that Teddy Roosevelt?
Or
Might have been.
I can't remember.
Yeah, my presidential history isn't very good. So it's kind of unprecedented, though. I guess that's the point, is that the scenario that we've got right now is different. So there's not exactly a playbook on how things play out between now and the end of the year. So again, expect uncertainty.
Absolutely. And so really, what has been driving the market this year. So as we've said, we say this all the time, right? Is that 70% of the economy is literally just people like you and me spending money, right?
Yep.
That's ultimately what's driving a lot of this stuff. And so employee compensation, disposable income, we do see, the PCE inflation. So that's the Fed's kind of key indicator that they like to use. So we do see that moving in the right area. So, a lot of the data that we're seeing in that is kind of going into what our returns have showed so far this year. Is it's not necessarily these specific 7 companies, it's much wider, but there's actual data to say this isn't, a bubble that's happening in the market. There's actual earnings. Now, do specific companies miss earnings in times like this? Absolutely.
Yeah.
That happens all the time, individual companies and their individual things. But when you look at the broader market, some good things are still happening out there, which is kind of what's been driving it to this.
Yeah, absolutely. Yeah, there's a lot of sectors that and sectors don't all behave the same way.
Yeah,
right? So
exactly.
you want to stay diversified. But overall, consumers make up 70% of the economy. So I think that, the slide here is important, right?
Mhm.
Talking about income gains, that people that want a job kind of have a job, right? And obviously we say that very broadly. I'm sure there's situations that somebody, right, that can't find work, or they can't find they got laid off, right, and they've got some gap in employment. But by and large, the labor market is very strong right now.
Mhm.
People more or less are working. I find this slide a little bit humorous on the right-hand side too, because the population ratio, they say the working population, at least that they're including the sample, is 25 to 54. And I'm only 5 years away from that upper end. And I know why they do it, right? Because once you get beyond 55, you do have a lot of people dropping out of the workforce, right? That are retiring. I plan on being here for a while, but the whole idea though is that it's trying to get the sample accurate, right? As far as the population, it's almost certainly going to be working if they can.
Yeah, and I think, and so this is one that did slightly change over the last week, right? So last labor market, labor things that came in did kind of throw the market for a bit of a loop, because unemployment rate actually did jump up a little bit. It's still very, very low, mind you, very doable, but the projection was just missed where economists thought it was going to be versus where it came in at. So that kind of
so it could be a sign of weakness in the economy. And we've seen individual companies, won't name any, but we've seen some individual companies this last week that have announced layoffs or early retirement programs, exactly, incenting people to leave early. So a lot of companies are repositioning right now. And of course, there's always some of that happening in the economy, but it was definitely a little bit of a spike from what we had been seeing before. Far cry from a couple of years ago, where companies basically couldn't find anybody, right? I mean, we talked to the average business owner a couple of years ago, and that was their biggest challenge, is they had open jobs and they couldn't find people to fill them. So that equation has changed and equalized out somewhat, and maybe that's a good thing. There are some benefits to that as well. Household balance sheets. So overall, the one thing we really wanted to point out on the right-hand side here actually is that households are not over leveraged. And I know we see that in the media sometimes. There'll be financial articles that say that the consumer is stressed and over leveraged, but the data really doesn't show that. The data really shows that we're much more like trend line looking over the last 30 years or so. Certainly the spike in the middle here, that was the financial crisis. People got way over leveraged in the mid 2000s. And of course, most of that was in real estate. Back then they had liar loans, they called them, right, where people could just fog a mirror, right, and say, hey, yeah, I have a paycheck for a certain amount, and they were able to borrow more than the house was worth. Really crazy lending practices that were happening back then. So the average consumer got way over leveraged. We're just not seeing that right now. Examples, right? I'm sure you can find people that are over leveraged, but as a whole, the U.S. consumer is actually pretty strong right now and in a good position.
Absolutely, and really and that's kind of the key. So I think the feeling in general, anyway, from what we've been seeing, is that during the pandemic and leading up to maybe into last year, was people had a lot more kind of cash on hand, right? Which was out of the ordinary.
There was pandemic cash still, being spent.
Absolutely, which was out of the ordinary. And so what we've seen, and what a lot of the data tells us, is that cash has now kind of been spent through.
It has,
right? And so yes, in terms of debt to maybe cash ratio, that ratio has increased, but really what the data is telling us is that that's really not, it's not like it's bad debt or excessive debt that most people have. It's just kind of honestly more in line with regular
historical average, which sometimes Americans are really good consumers, right? I mean, we're good at spending money, right? I mean, which is good for the economy in the short run, but obviously a lot of individual situations that are tough because people take on too much debt. And it makes their financial situation tougher than maybe it would have been. So inflation is definitely coming down. You can see on the slide here, actually kind of a sampling December 2019, right before the pandemic. Inflation actually was pretty tame back then. And then kind of after the pandemic, and we saw a big spike, right? A lot of government money that got thrown into the system. And however you feel about that, politically, but it was a lot of money, trillions and trillions and trillions of dollars that got that got borrowed effectively and got pumped into the economy, sent out to consumers, as we were talking about before, sent out to companies. There are all kinds of programs, right, to try to keep us from going into a recession, to kind of boost the economy. So again, however you feel about that, bottom line is it did create an inflation problem. There was just a lot of dollars out there chasing not enough goods. We also had supply chain issues kind of happening at the same time. You might remember that after the pandemic, big time disruption in supply chains. And so it really created this perfect storm, right? That you had just way more money than could be spent, that people really couldn't even buy stuff, they couldn't travel, and so forth. So now we've seen things normalize, come much lower to long-term trend is about 3% over the last 100 years or so. That's just normal inflation, about 3% per year, versus the spike in inflation that we saw a couple of years ago. Now, a lot of that's abated. And the Fed's been very concerned about letting off, too soon. In other words, they've really hit the brake when they started raising interest rates. And they've been concerned about, what happened back in the early 80s as the Fed let off too soon. Inflation came back. They had to go back and kill the dragon again, right, with some much more aggressive rate increases. And so that really is more or less kind of the narrative of what is going on, in their mind. Now you definitely have seen that shift, though. You definitely have seen the inflation numbers come down enough, and the Fed is kind of turning their attention more on, hey, we don't want to have a recession here. Or if we do, we want it to be a really shallow recession. We don't want the economy to slow too much. We don't want the unemployment rate to spike too much. They're much more concerned about that. As you see them shift here over the next month, in their commentary, you can see that they're really more concerned about that.
Yeah, and the data behind this one, I think, really kind of goes to a lot of what you hear in the media too, is that there's a little bit of a disconnect, right, from what you hear in the media versus what the data tells you on inflation.
Right.
It's because the data tells us, yes, that PCE and that inflation data is coming down. It's heading in the right direction. But then you go to the grocery store and you say, what's going on here? I thought inflation was going down,
Yeah,
right?
exactly.
Or you go to fill up your car, where's that inflation going down from, right? And so really you have to think about inflation, just like we were talking different sectors. And we've hit on this before, is that inflation doesn't just hit every sector the same at the same time, right? There are leads, there are lags in all of these. What the Fed is looking at is overall, what is the trend on all of this stuff? But let's face it, usually when corporations get a chance to raise prices on something, they're very, very hesitant to drop it
lower
back
prices.
down.
Yeah, that's a really good distinction. Yeah, because it does depend on what you're buying, right? And we all need food and gas and things like that. So, the average consumer has been stressed, not only because of the spikes that we had seen before, but yeah, you really aren't seeing a lot of price reductions, right? I mean, a lot of the inflation that we've experienced, well, that's the new set point, right? Essentially. And so really when we talk about inflation coming down, it's not about prices dropping. That's not happening, right? We're just seeing the pace of the increase, right? That's what's changing. So in other words, for those of you out there that I don't buy it, I don't think inflation's coming down. Well, you're right. I mean, in the sense that you're not seeing prices drop, and I wouldn't hold your breath, right, for that to happen, unless we truly do have a bad recession. And that's about the only time, overall that you see a drop in prices is if you have a really bad recession, you'll actually have deflation. And that's not a good situation either. So just to be clear on our definitions here, that's kind of where we're coming from.
Absolutely. And we kind of hit on this one earlier as well. The fundamentals behind stocks actually do look really good. So this is not, the data behind it, the earnings, save for a few specific companies, which we've seen over the last few days in particular. It's pretty wide across the S&P 500. And really, when you think about it, what drives a stock's value?
Just earnings.
The earnings behind it. Is the company financially sound? And that's shown in their stock price. And so really, as we look across the broad market, for the most part, yes, absolutely. It's very wide across the S&P 500. And there's some good data behind that, which is a good feeling, I think.
It is. And yeah, that's a good perspective, I think, as far as they're just remembering what a stock is, right? It's a company, and it's a share of a public company in most cases, right? The ones that we're familiar with tend to be public companies. And at the price of that company is based off of what they expect earnings to be in the future, right? So if even if you had just a small business, say you owned a gas station on the corner or something like that, and they were doing a business valuation, well, that's what they'd be looking at, right? Is they'd be looking at all the factors and what do we expect your earnings to be in the future? That's the value of the gas station. The value of the real estate in most cases is insignificant, for companies, and even more so now, right? With office space, being much less of a thing, right, for many of these big tech companies and companies that don't really have a manufacturing presence. In other words,
Yeah.
it may be less and less as far as something that would be on their finances. So it's not a bubble. We don't think it is. Certain areas, yes. I mean, clearly there are certain
Right.
stocks that probably went up too much, too fast. So that's again why we want to stay diversified. We want to avoid chasing stocks and over concentrating into kind of the hot stock, the stock of the day. That's where you're sure to get hurt. Eventually you hold on to any stock, no matter what kind of company it is, eventually you're going to get hurt if that's all you own.
And that's a really hard thing to, I think, qualify in your head, right? Is because you do see that everybody, I think, has this desire to say, what's the next Google?
Right.
What's the next NVIDIA?
Oh yeah,
That's
absolutely. That'd be
come
great
out,
if you knew that.
right? Do I own that? Do I not own that? Where does it come? But it's a lot of trouble you can get into. And so even, the big dropbacks that we had earlier this week that we were seeing and kind of a little last week, those big companies like your NVIDIAs, they were jumping up because of AI, right? And everybody's like, oh, I got to get on the AI train.
Yeah, it kind of sounds like the internet of the late
Right.
90s,
And
right?
now the market's saying, wait a minute, we should take a deep breath. Maybe this AI thing isn't going to be as big as we think it is.
Right.
Or trying to place bets, and there's that uncertainty around it. Did we go too far? Did we not go far enough? But really, again, that's kind of those one-off companies, right? When we look at the broader market, really it is spread out across the entire market.
Yeah, but it is. And, just to make everybody feel better too, if you're thinking about what, shouldn't I have a little bit of NVIDIA or a little bit of Microsoft or, whatever the company it is, trust me, if you're a diversified investor, if you own, stock mutual funds or stock index funds, things like that, sure, I would be really surprised if you didn't own little pieces of those companies, if you really dissect the fund, right, and see what's in there. So again, it's a trade-off, right? You're trading off making a killing, you're trading off getting killed. For most people, especially as they start getting closer to retirement, they definitely want that trade-off. They definitely don't want to see a massive drop in value just because they had too much of one stock.
Absolutely.
So there are pockets of opportunity. Again, the large growth, U.S. growth, if you hear that category, that largely is big tech companies. That was really where most of the growth came from over the last couple of years. So if you had exposure, great. I'm sure you did. We did as well, but we definitely always want to still have those other areas. Emerging markets, U.S. value, U.S. mid caps, small caps, all those areas. You always want to have a little bit of everything, right? And of course, rebalancing is important too, so you don't get over concentrated. And certainly, we've been doing that throughout this run, right? Making sure we're rebalancing appropriately and not getting too much into one area. So again, back to politics, everybody's favorite conversation, right? So, regardless of political party, and the whole point here is the yellow diamonds here show that every president, there's never been a president where the market didn't have a big drop at some point during their presidency, some a little bit more, some a little bit less. But the market kind of likes gridlock, and this next one kind of points to that. Is sometimes we hear people say, well, the market really likes to do better under Republicans or likes to do better under Democrats. And, based off of the research on this one, actually does show Republicans beat Democrats. But the reality is investors kind of like gridlock. They kind of like it when it's a divided political situation like we've seen, right? It's been a while since we've seen one party just have overall control of one side. So and it's likely to continue. I don't know the outcome of the election, right? There's a lot of time that can certainly come out here, but more than likely going to be a divided political situation.
I think the other part of that too is that not only just investors like that gridlock, I think corporations like that gridlock as well.
Yeah.
Because when you're setting corporate policy or you're trying to, bet on earnings or bet on what's going to happen in the industry. It's a lot easier to say if it's gridlock, I know there's not going to be major swings one way or another, right?
Yeah.
Whereas if it's one way or the other, you know, those corporations have to take that into account.
They do.
What kind of policy
Yeah.
shifts am I gonna have to deal with? What kind of tax changes to the corporate rates are we gonna have to deal with? Tariffs, you know, any of that stuff, it all
Yeah.
plays in, right?
Yeah. So yeah, I think the market, at least if history is our guide, the market will like it. If there's a gridlock type situation after this election, regardless of, you know, which party and so forth controls the presidency, divided political situation, although it can be frustrating because, you know, nothing gets done, right? Sometimes the market likes that, right? Again, because corporations can have some certainty, you know, that they're not going to see a political curveball thrown at them. So a little election primer, policy primer here, and we're not going to go through this in detail just for sake of time. This isn't a political you know, webinar, but certainly it has an impact. So policy changes. Obviously, if you see a deep blue outcome where you've got actually not Biden, right? It would be Harris, Harris plus both houses in the blue. You could see some changes, right? You could see some changes, especially some of the tax cuts that expire in 2025 or after 2025 may be allowed to expire. Likely some things would be continued on. We don't know which right now, but it certainly could impact some people. If you see deep red, which you'll notice we kind of goofed on this one on the far right, you know, if Trump wins the election and both the House and the Senate are Republican, deficits are likely to increase. Actually, you know, neither party, it's kind of funny, neither party has been fiscally conservative for decades, right? I mean, I think the last time really was when Bill Clinton was president. Right.
Yeah.
And he actually had a Republican Congress, interestingly enough, right? You had a Democrat president, Republican Congress, and they actually kind of whipped the deficit temporarily, right? But historically, politicians don't like to do that, right?
No.
They like to spend.
I don't think most politicians know what a balanced budget is.
No.
It's
No.
just where do I want to push the money?
Yeah.
Right?
Yeah, absolutely. So under Harris win, especially if you had you know, Democrats in control of both houses, you could see a deficit reduction if they control spending, right? If they increase taxes and control spending, you could see a change there. So again, this isn't a political, you know, they're just some possibilities, right? But bottom line is the most likely outcome of the election is going to be some level of gridlock, and you can see from the chart that means not a lot of change. Not a lot of change. Again, some things could go up when tax cuts expire, and they may be allowed to. Then you could see some increases in some of those rates. But even a divided political situation, you could see people come together, right? And that does happen from time to time.
Tax cuts expire 2026.
Yeah.
So
yeah.
that's another webinar in and of itself.
It is. Yeah, it is. And if you're concerned about it, again, it is another webinar, but if you're concerned about it and how it affects your planning, certainly let's talk about that in our discussions. We're going to hit a couple bond slides. Bonds aren't as exciting as stocks, right? But bonds are still important, right? The fixed income component of most people's portfolio. Long-term forecast at this point, where rates are today, actually has a 5% long-term annual return for bonds, which historically is about spot on over the last 100 years. That's about what long-term bonds have averaged. Cash rates or short-term treasuries more like 3%. So that is back more like a normal long-term rate expectation. If the Fed cuts rates, I think it's when, right? And probably September. Almost certainly, I think it would be really unlikely unless we just saw some crazy spike in inflation between now and then that they're going to start lowering rates back down. Some are actually saying that they waited too long, right? So we'll see. Time will tell on that. But yeah, long-term bonds, certainly that environment should do better than short-term bonds. We talked about diversification. Certainly, you know, depending on what happens here overall with the economy, you might find that stocks don't do well for a while. You might find that the commodities don't do well for a while if the market, the economy goes backwards for a bit.
And that's why we own a little bit of everything, right?
Yeah, we do. And everybody has a risk number, whether you know it or not. Everybody has a risk number, right, on a scale of 1 to 100. And most people have no idea. You know, of course, our clients are different, right? Because we talk about this stuff, but most people have no idea how much risk they're actually taking in their portfolio. So it's important that you've got the mix correct between these different areas, because the reality is there are going to be different seasons of the economy, different seasons of the market, just like there are seasons of the year and seasons of our lives, right? It's important that you're kind of prepared for those and have a portfolio that you can live with, right? And kind of ride through those different environments.
Yep, and then of course, I think we've been saying this all along, is that stocks continue to be that best hedge against
Yeah,
inflation,
over the long run.
right? Over
Yeah.
the long run. We always, that's not to say that we don't want to own probably some bonds inside your portfolio. Again, depends on your risk level. But history pretty much tells us that stocks are that best inflation hedge. They are the best way to, stay ahead of it and get that extra growth on it. How heavily weighted in stocks depends on you and depends on how much volatility you're willing to have, but that just kind of still remains the fact.
Yep. Yep, absolutely. So over the long run, it's kind of like if you're trying to get to Australia from the US, there are different ways, but the reality is that probably the best way to get there the fastest is going to be an airplane. I don't know of any other alternatives right now, right? When we find them, we'll talk about it. But I think that's why, why do we always talk about stocks? Simply because over the long run, that's been the most reliable for a long-term holding. Again, I say that over and over simply because there will be periods of time where they look really ugly, and that's the price that we pay, right, to get those higher returns over the long run.
Yeah, absolutely.
So a little positioning, right, overall, comfortable overweighting stocks that we still are. That hasn't changed a whole lot.
Absolutely.
Yeah.
And US stocks probably over international.
Mhm.
Not saying that we'll ever completely get rid of international.
Yeah.
Because it still serves a purpose, but right now that S&P looks pretty darn good.
It does, and certainly the S&P plus other parts of the U.S. market as well. But you look at international investments. I don't think it would be wise to not have any international investments. But historically, the U.S. market has tended to outperform international investments. It's also been less volatile. But interestingly enough, we play with some different portfolios and things. Historically, if you add about 20% ish of your portfolio into international and 80% in US for your stock portion, it actually has less volatility over the long run than if you went 100% US or 100% foreign to actually having some mix of both. So again, it depends on the investor.
Absolutely. And then this one makes a great point too. Seek diversification opportunities and be patient.
Yeah.
Right.
Yeah, and that's
So
hard to be patient.
it is.
Yeah.
It's so easy to get caught up in the short term, especially in an election year.
Yeah.
Because you're always watching it. And nowadays we just tend to have big swings, right? Up and down.
Yeah.
Which kind of tends to drive you a little bit nuts, to tell you the truth. But just keep that focus on the fact that we have a long-term planning horizon that we're working with. Obviously, we're going to be doing things in the short term to manage it, right?
Yeah.
But keep the focus on that long term, and all of this stuff kind of fades to the back.
It does. And, my 2 cents, but I think sometimes people log into their accounts too often. And of course, I think it's important that you know how to do that, right? It's your money. You need to be able to have that transparency. But if it's just morbidly fascinating and it's causing you stress, losing sleep at night, things like that, then it probably is too much. Different institutions have done studies on this that the more often that people log into their accounts, I think Fidelity specifically, Fidelity's done studies on this. They can tell, right? They can tell when people log into their accounts, and there's a correlation between the more people are logging into their accounts and the more stuff they do, right? The more trades they place, and oftentimes those trades aren't good ones, right?
Absolutely.
People just kind of reacting. So. Yeah, and again, valuation opportunities. If you get out of just those big names, the big tech names, there are a lot of other parts of the market that are not overvalued right now. Underweighting bonds, I think for most people, it depends on you as an investor. Again, everybody's individual, so we're kind of making some broad brush statements here. Always staying diversified. Having lots of asset classes covered. Again, election results rarely make that much difference in the long run. And again, I'm sure a lot of you would debate that and say, no, it matters. Personally, right? It matters a lot, right? Who wins? I would agree, right? We all want to participate in that, but you never want to make market-driven decisions off of politics. It would just be a really tough way to make money over time if that's how you were managing stuff. So tax management, I did want to hit on that. You and I spend a lot of time with people on tax planning. Right, we're not tax advisors, right? You still, need to have somebody preparing your taxes or have a CPA involved in your planning. But we have done a lot of tax planning that can make a difference as well. As far as looking at opportunities, Roth conversions, accelerating gains, there's lots of things that we can look at to see what the impact would be.
It is, and it's kind of a moving target, right? It depends on what's happening in the market. If the market's up versus market down, tax loss harvesting. And it's different for everybody. It depends on, what types of accounts you have, what types of investments.
Yeah. Yeah, sure does. Yeah, and what we're trying to solve for too is kind of long-term. What's the lowest lifetime rate of taxes somebody could pay? And then again, we're using a lot of assumptions because we don't know, right? Every year, Congress tends to monkey with the tax code, and politics can have shifts in that over time. We're working off of imperfect information because we can't predict the future. So, but it does matter. Taxes do matter as far as your long-term returns. So overall, good advice, seeking that out. And we hope that's us, right? If we're a good fit for you, that's awesome. We want to make sure that you've got a good long-term plan, that you stick to it, and that we're not just looking at investments, we're also looking at other aspects of your planning. Again, your taxes, your estate planning, your family dynamics, those things all kind of play into this.
Absolutely.
We get another disclosure slide here. So read that quickly, a little footnote action right from all of our slides.
And now's your chance. If you haven't already asked a
Please.
question, please use that Q&A section to throw it in there.
Yeah. We've hit a lot really quickly. We know it's throwing a lot of information at you very quickly. And we certainly respect your time. We know that you've got a lot of other stuff going on, whether you're listening to this on the podcast, on the website. We want to make sure that that you hear our voice and you have the opportunity to get your questions answered. You'll notice on this slide, you call it making the complex simple, and you might look at it and say, that doesn't make anything simpler, right? The reality is the financial world is very complex and it changes constantly. So we want to make sure that we're here for you. We want to be your partner in that. Certainly, it's always your money, right? You're always involved in the planning, but we want to make sure that you've got a good partner, right? That is your trusted advisor, right? Over time, we want to make sure that we get to be on that journey with you. So lots of different stuff: estate planning, tax planning, Medicare. How do I sign up for Medicare? Lots of different areas that you might need our help with over time. And there's our lovely team. You can see all of our folks. We've got a great team, decades, I think hundreds of years of experience, probably if you add it all up at this point. So I just hit my 25th anniversary last week as an advisor. So a lot of experience, and certainly a lot of people that care about you, right? That want to do the best for you and your family. So I appreciate that. Certainly want to open it up for any questions. You can see our contact information on the slide. So if there's a question you want to ask later, you can certainly do that, or just a situation you want to talk through. Just Josh at KeystoneFinancial.com, Jeremy at KeystoneFinancial.com. And of course, our website is KeystoneFinancial.com.
Absolutely.
All right. What do we got for questions?
We do have one question out here.
Good.
What are your thoughts about Warren Buffett recently selling half of his stocks? Could this have affected the past crash? So specifically, I think what they're getting after
Apple.
is, he had about half, he sold about half of his ownership in Apple specifically. Anytime anybody that big shakes the apple tree,
right.
Stuff's gonna happen. So there's, you'd have to honestly talk to Warren Buffett about why, the why behind it. He's a pretty shrewd guy, and he does look at value and a lot of that as well. And so, yes, that absolutely did. That was, and I say it did have an effect on kind of what happened in the market, mainly because that was huge in the media, right?
It was.
That was, I remember the day he did it, there was a big, that was kind of front page on my news feed that says Warren Buffett sells half of his Apple stock.
Right.
So if I'm seeing that, I guarantee there's millions of other people seeing that as well. So
yeah. And if you really read into it, Buffett also said that there's no plan to unload the other half, right? In other words, that they still believe in it as a long-term holding. So I take it as that is just that Buffett and the rest of the Berkshire Hathaway professionals, right, that manage that money, that they're prudent investors, right? And that if they've seen a run up in a particular stock, or maybe they're seeing other opportunities out there that could be coming up, they want to position for that.
Absolutely.
So, and certainly you've got decades of track record there, right? Not recommending Berkshire Hathaway stock, just to be clear, right? Not saying it's bad either. You might own it already, but it's kind of an interesting company because it almost operates it's almost like a mutual fund, right? Because it's such a large conglomeration of different investments that they've made.
Absolutely. Yeah. And I think that's a good point too, is kind of where Buffett comes from specifically when he does do trades. It's funny to me how many people watch him and then trade accordingly. And he's not going to share his secrets with anybody, of course, but a lot of it comes down to fundamentals for him. But I'm sure if it was different, if he did say I am selling 100% of my stake in Apple.
Mhm.
That's a pretty big move right
It
there,
would
right?
be, it would be.
But,
It might just be that he wants to buy something else more, right?
Which could very well be
Yeah.
the case, is that you saw that there was a whole slide previously about undervalued sectors,
Mhm.
right?
Yeah, yeah.
Tech was not one
not
of
one of them, no, no.
So I think he also sold off some other things in there. They just weren't as big as Apple. So I could definitely see it more along that lines of, hey, there's opportunity over here and we already capitalized in this section.
Mhm.
Let's do this.
Yep, yep, absolutely.
Yep.
What other questions? Anything else out there right now?
You know what? That is it.
Good. Any other questions that you've got? Of course, you can send them off to us. We'll give people a second if you want to throw any questions into the queue. But yeah, certainly, I think a lot of the questions that we're getting right now, as people call in, a lot of it's just their individual situations. Frankly, we haven't, we always, it's funny, whenever the market pulls back, we'll have clients say, have we been getting a lot of phone calls? Or, I think maybe they just expect that's happening. We really don't. It's not common. There may be certain clients that have questions or concerns. I think especially if they've been paying attention to a lot of the media. Remember that the media is not really your friend, in that they're mostly reporting negative news and they're sensationalizing it. And it's not to say it's fake news necessarily. I won't go that far to say that it's disinformation, but just recognize, the business that they're in is advertising. It's an advertising business, and if they can get people to click, really, it's all about that. It's about people's attention, and the more they can do that, of course, and the best way they can do that, they know, is to scare us, right, or get us really angry, or get us angry with each other, right? And I think that's if you're seeing a lot of the division in the country and in the world, a lot of it's it's being stoked by social media and kind of the motivations of those business models. So, so that's a lot of the questions that come up is, around politics. What's going to happen if, so-and-so wins or so-and-so wins or,
Absolutely.
right. So, and
know.
the answer is we don't know, right?
Yeah, and I know one piece of advice you used to give,
Yeah.
I've heard you say it for years, is just kind of guard yourself, right?
Mhm.
Guard yourself against what you're hearing. So everybody has those, specific media outlets that you like or you listen to, or, they've done you well in the past. Just guard yourself from what you're hearing, because I know you're inundated and it just gets worse all the time,
Mhm.
right? They find more and more ways to send you articles and whatnot. And of course, with AI being included in all of that
Mhm.
now it's
Absolutely. Yeah.
a computer that's helping them and
Yeah.
saying, hey, they looked at this
Exactly.
earlier, so
Yeah,
let me
it's
show you
it's
more
not
about
even
that.
it's not even a
Right?
human. If you go to such and such news website, it's not even a human anymore that
Yeah.
decides, where the article should be or what the headline should be. More and more they're using AI too, right?
Absolutely.
Because it works.
And I think that's
Yeah.
just going to continue on. So
Yeah.
I think that's more important advice now more than ever.
Yeah,
It's just-
be the gatekeeper of your own mind. I think
Yeah.
gosh, was that Jim Rohn? Might have been. I
I
can't
think you're
remember.
right.
Yeah, it might be Jim Rohn. But yeah, be the gatekeeper of your own mind, because nobody else is going to do that for you, right? And there are a lot of a lot of players out there that that want to get you scared, that want to get you angry, and a lot of times emotions don't have a very good correlation, right? If we have high emotion, it doesn't oftentimes lead to good financial decisions. So
Absolutely.
just have to be cautious with that and be aware. Not to say you should just be ignorant and not go on, and find out what's going on in the world. Just kind of go into it knowing that, right? I think that's a better approach versus just kind of blindly, listening to whatever it is that you're paying attention to. So anyway, it's soapbox for today, right? But I think that is important. So,
Yeah.
but yeah, we just really appreciate you. We appreciate the relationships we get to have with you and your families and coworkers over a lot of years. For many of you, it's been 20 plus years. Certainly appreciate that. Appreciate the trust that you put in us. And of course, there's going to be a lot of interesting turbulence coming up. A lot of stuff that'll happen between now and the end of the year. So we'll be talking about that with you individually, of course, and there'll be more opportunities like this as well. So
Absolutely.
thank you. Thanks for taking the time today, and have a wonderful week.
Take care.